Over the weekend, there was some speculation from the president that a 50-year amortization mortgage might be a tool for helping housing affordability in this country. On Twitter, I pointed out that the average age of home buyers right now is over 40. So in that light, a 50-year mortgage seems kind of incongruous. But the notion seems to have touched a nerve. So today I thought we'd take a look at the 50-year mortgage concept as we review the latest real estate market data that came in this week. My take on the 50-year mortgage is that it's not a positive or negative in itself. It would be an option for financing. But the key is that we have an affordability crisis in this country, not for lack of financing options, but because we heavily subsidize homeownership. Through things like cheap mortgages and tax advantages and zoning laws, we support the prices of homes, and the system works to keep home prices rising year after year. One downside of this system is that it has made homes unaffordable to those who don't already own. So we have an affordability crisis in this country. Does a 50-year mortgage help affordability? Well, if you look purely at monthly payments, obviously stretching your payments over 50 years should lead to lower payments than your 30-year mortgage. But longer duration loans tend to carry a higher interest rate. And as of now, the 50-year is a non-qualified mortgage, which means that it'd carry an even higher interest rate. A better path to fixing our affordability crisis is to let incomes grow faster than home prices for a while. That, by the way, is what has been happening for 3 years now. Incomes have been rising about 4% a year, and home prices are basically flat or down during that time. So the price to income ratio for home prices has been slowly, steadily improving. The structural affordability challenge has been slowly improving because of higher mortgage rates. Higher payments are slowly forcing lower prices for the asset itself. So let that sink in for a moment. Today we'll look at the latest home sales data from the week, plus inventory pricing, and we'll take a look at affordability through this lens of the monthly payment. I'm Mike Simonsen. I'm the Chief Economist for Compass. I do this data every week because I believe that the data helps everyone make better buying and selling decisions. If you like the data, please join the Compass Intelligence mailing list. There's a link in the description below. Click that to join us. Okay, let's take a look at this week's data. So let's start today with home sales. As we track the weekly pending sales contracts, home sales are growing versus last year. So we are averaging about 4% more contracts pending each week than this time last year, about 4%. There were 59,000 single-family homes newly in contract this week, plus another 12,000 condos. The recent average has been about 61,000 new contracts per week for single-family homes. So that compares to an average of 58,000 last year. So last year in November, mortgage rates were spiking again. So in addition to the normal seasonal slowdown, the weekly pending sales hit the brakes pretty hard last year. This week, we actually counted 15% more newly pending home sales than the same week in 2024. Now, this growth is a reflection of how slow sales were last November. Not that sales are surging now. But any growth over last year is welcome. So I'm giving a talk in Texas tomorrow, and I think it is notable that the metros with the best sales growth over 2024 are Austin and San Antonio. These are the same places where inventory is up the most and prices are down the most. So an uptick in buyers there seems meaningful. It's definitely something I'm going to keep watching. In this chart, we have the national weekly pending home sales data. The blue line for 2025 continues to track a little better than the same week in 24 across the country. We've been averaging about 4% more weekly pending contracts each week. As more contracts get signed, that implies more sales will complete in the coming months. This is the same growth pattern we've been talking about for a few months now, continues to this week. Home sales, when all the data is finally collected and reported for 2025, looks like very likely to show a couple percent gains over 2024. So another local note about home sales growth is that many markets' sales are flat or up just a tiny fraction over last year at this time. But the weekly pending data in Florida is up pretty big. Florida is running about 10% more sales now each week than a year ago. And Florida is the second biggest state for home sales after Texas. So in this data, Florida is running like 3,000 sales per month ahead of last year. That growth is more than 23 states have at all. Like 23 states do less than 3,000 sales per month. And that's how much Florida is now currently growing over last year. So Florida home sales growth now is partly because last year was a big hurricane year with 3 storms, and there haven't really been any this year. It's unclear to me how long Florida's sales were depressed because of the storms last year. So we can see in October, Florida has 10 to 15% more sales each week now and into November. Will that pace last into January or later in Q1? So I'm expected to some continuing sales growth, but not quite as strong as we see right now. Let's look at the current affordability levels. So there are 3 variables for affordability. There's the price of the house, there's the income of the buyer, and there's the cost of the financing. The structural part of affordability is the cost of the house and the income. Mortgage rates have been easing lower in the past couple of months, though they've rebounded in the past 2 weeks since the Fed meeting. As the median price of homes ticks down for the fall, mortgage rates are near the low end of where they've been trading this year. So payments are roughly at their lowest levels of the year. So in this example, I have median priced home, which is currently $397,000, assuming a smallish down payment and a current mortgage rate of 6.22%, which was the average from Freddie Mac last week. So these assumptions create a hypothetical roughly $2,250 monthly mortgage payment. So that's illustrated here in the blue line. Payments are currently cheaper than last year at this time and cheaper than earlier in this year. Last year in September, mortgage rates hit their lowest level in years, so it's September last year, and buyers reacted. We haven't quite gotten back to that affordability improvement we saw for a few weeks in 24. So if we're lucky, mortgage rates dip closer down to 6% and start the spring, and that helps a lot of potential home buyers. So how might a 50-year mortgage impact payments? So the idea for a 50-year loan is that you'd spread those payments over 20 extra years, so each payment would be cheaper. But we also have to assume that a 50-year amortization loan would carry an interest rate premium over the 30-year over shorter duration loans. So what that premium is depends a lot on market or regulatory factors, but assume some premium. So for example, the spread between the 15-year fixed and the 30-year fixed is 50 basis points. If you assume a 50-year loan carries maybe 50 basis points more than 30, that means with the assumptions I'm using here in this chart, the monthly savings on a 50-year loan is only like $115 a month. So you stretch your payments over 20 more years and you save $100 a month. At first glance to me, it seems like that's probably not enough to move the needle on affordability and therefore do anything for housing demand. Once you factor in the massively increased interest costs over time, my suspicion is that very few homebuyers, especially first-time homebuyers, would opt for a product like that. From time to time, we see attempts at innovation in the mortgage space to give buyers more options on how to finance homes. Almost all of these products fail because they're just not that good a deal. Like if you pay more in interest and you don't build equity as quickly, is $100 a month enough to move the needle on affordability? My suspicion is no. Okay, on to home prices. Home prices are in their seasonal decline now. The median price of homes that started contract this week was $391,000. The recent average is $397,000 for single-family homes. These are the homes that started contract this week. They went pending. This price point is the price point that people are buying. It's still a couple percent above last year at this time. In this chart, we see the seasonal curve for each year. The blue line for 2025 is just starting to tick lower. I'm using a 4-week rolling average here to smooth out some of the weekly noise. But last year at this time, the purple line showed some late year strength when those mortgage rates dipped in September 2024. But by November last year, mortgage rates were spiking again, and home prices in the last couple of months of the year resumed their normal seasonal decline. This view also has 22 and 23. In March, April, May, June of 23, the orange line shows pricing was below the previous year. By this measure of home prices, we are now not yet in that space of declining home prices that we saw nationally for a few months in 23. The headlines are for home prices nationally still positive from last year, but there are some indicators of home prices that are already negative compared to last year. And those metrics bear watching so that we know what's coming to the headlines. So I've highlighted recently this stat, the median asking price per square foot across the country. Price per square foot is a nice, handy, sort of normalized view of prices. And what's important right now is that when talking about home prices, this measure is showing prices less than last year at this time. So even as most other, home price measures are still positive versus 2024, in this chart you can see easily see that seasonal curve of home prices. Each year, the best properties with the most demand happen in Q2. Prices peak in the summer and then decline for the second half of the year. In 2022, the yellow line here, we were still gobbling up everything and home prices kept marching higher. After June 22, home prices declined faster than normal in the second half of the year because demand stopped cold. So sharp up and sharp down in that 22 yellow line. This year's blue line tells a different story. The median ask price per square foot is now $212. That's not quite 1% less than last year at this time. This shows prices declining at a faster than normal seasonal pace this fall. The blue line is below last year's purple line, and that gap is widening. So these are asking prices. This is a leading indicator for sales that will happen sometime in the future. This implies that sales prices in the future will continue to have downward pressure for now. Even though we can start to see sales volumes tick up, I mentioned that sales are up about 4% over last year. Supply is still up more than demand, right? And after several years of that imbalance, prices seem poised to continue to adjust. So I expect home price headlines to report negative changes sometime in the next few months based on data like this. Let's finish today with a look at the supply side. So there are 842,000 single-family homes on the market around the U.S. now. That's down 1.7% for the week. And it's the end of November, so that's to be expected. Inventory falls now through the new year. There are 16% more homes unsold on the market now than last year at this time. Inventory of unsold homes on the market continues to grow versus a year ago. So in the tightest inventory markets like Illinois or New York, inventory is up 10 or 15% over last year. In the big states like Texas, Florida, California, the pace of inventory growth is a little faster, closer to 20% year-over-year growth in inventory. So home sales are climbing, but inventory is still climbing a little bit faster. So this tells us we have not turned the corner on our pricing yet. Price pressures are generally down because of 3 years of supply-demand imbalance. So even though demand is inching higher, supply is up 2 for now. So in this chart, each line is a year. The blue line from 2025 shows us how inventory is nationally back to the pre-pandemic levels. I have 2019 here in orange, so you can see the old normal levels of inventory. So we'll end the year with just under 800,000 single-family homes on the market. The trend to watch now is whether the growth pace slides even further in 2026. So inventory is now 16% greater than a year ago. Does that slide down closer to 10%? If we get lucky and mortgage rates decline from here, keep a watch out for that trend. If we get unlucky and mortgage rates climb from here, that would imply to me deeper price pressures as inventory continues to grow. Okay, that's all the time we have for today. I'm Mike Simonsen. Thanks for watching. If you like the data, please join us on the Compass Intelligence mailing list. There's a click the link below in the description below. Thanks. We'll see you next week.